Roll. Hello, my name is Keith Steincamp CPA. I'm the CEO of Achieve Business Advisory, and I do business coaching, which is helping business owners to grow their business and be more profitable. And then I also do what's called Contract CFO, which is Chief Financial Officer, and we'll talk some more about those things. And I'm here with my good friend King today, and we've got some exciting questions for you, so we're looking forward to that. And tell you a little bit about myself. I've been in business over 30 years. I'm a certified public accountant, but my background is more just in financial and in financial management, director of finance positions and chief financial officer positions, as well as different roles where I was helping businesses to get to the next level and to grow and to make more profitability and to, in particular, serve their customer better and achieve better things so that the customer is better impacted and the company resonates and gets good traction with the customers, and the customers come back and the owner is able to make more money. And so we're going to be visiting about several different aspects of business today, and we've got some fun questions, and King is going to do some interviewing here, and I'll field the questions, and we'll have some interaction back and forth. So let me turn it over to King.
Great. Thank you, Keith. So my first question would be, what role does a fractional CFO play in a small micro business?
Yeah, very good. So, there's a statistic that like half of the businesses fail within the first 5 years. And so what I'm doing as a fractional chief financial officer is I'm trying to help you reduce your risk and have a better chance of succeeding in your business. So we help you increase your chances of success and decrease your chances of fail. And so we help you take the worry out of running your business. I like to think of it kind of in a football analogy. We help you to build a great offense and to build a great defense. So like, what are we offensively doing? We're helping you to learn to grow your business and to make the best moves to expand your business and do things like getting more sales. And then we also help you provide a great defense. And we help with things like making sure you have enough cash flow, helping your planning and helping you control your expenses so that you can make a profit and you don't run out of money. We also help with some of the nuts and bolts of your business, which is like planning and staying in compliance in your business with important things like, paying your taxes, but not paying too much taxes, making sure you have the right insurance, and helping you, know how to treat your customers and your employees and focusing on the overall things that make a business successful. So I like to think of it as we want your business to be a happy environment so your customers keep coming back. We can also help with things like getting your business set up properly and helping you choose what type of business you want to have, a sole proprietorship, an LLC, or different choices like that. Get you registered with the Internal Revenue Service and the state. We help coordinate things like, preparing your financial statements, taxes, payroll. We help you with, coming up with a business plan, which is what the plan is, written plan for your business. You're doing your goal setting, as well as routinely meeting with the business owner to figure out where we're at on things, what we need to tweak to get back on plan, what's working and what's not working, and what we need to do to correct it. So in working with business owners, you're always in charge of your business. I'm never running the business, but we help you to get clarity on what the best business moves are at the best time. So we're really there to be a support to you and to help you with different aspects of the business.
Okay, great. Now, next question number 2. What's the difference between a CFO and a CPA?
That's a great question, and that is kind of a confusing thing. Let me go through the abbreviations of what they're called first. Now, the first one that we talked about there is a chief financial officer, and the other one is a CPA, which is a certified public accountant. So the first one, chief financial officer, that's typically the lead financial person that works for a company. So like if I've got if you've got your own company, you'll have a person who's kind of your main financial person or your financial leader. and that would be called your chief financial officer. Now, some companies are small enough that they don't have a chief financial officer yet, and because it would be too expensive. And then also, they may not need, they won't need a full-time expertise a lot of times if they're just starting out. However, one of the things that I focus on that's a little bit unique is I've taken it where I'm helping several different companies at once, and it's typically on a smaller scale. So these are companies that aren't big enough to have a full-time chief financial officer, but it allows them to still get the expertise of a senior experienced financial leader, so that I can help them in that way. But it's just on a much more part-time basis. But that's a chief financial officer. And a CFO works for a certain company. They're responsible for, I like to think of it as they're responsible for the overall health of the company from a financial standpoint. So it's like, as an example, if you were the director of human resource, you'd be in charge of the hiring and maybe the firing and, training people, that kind of things. That's the role of a human resource leader. So you're kind of in charge of the people aspect of it. If you were the director of food operations for, let's say, a hotel, well, you're in charge of making sure that the food is good, and that's kind of your domain. Well, a chief financial officer is kind of in charge of the financial health of the company. So we're working on helping the business owner to be successful from a financial standpoint. And so that's kind of the chief financial officer aspect of it. We're helping the company to be more profitable, to grow. We do things like looking at all the things that makes a company profitable and helps to make the company better. We would work with HR directors and enable them and support them. We would work with the food and beverage person and help them, to do things that they can do to improve the company from a financial standpoint. We'd even work on the customer service and with the customer service people and help them to make sure that we get the barriers out of the way that keep them from being able to help their people serve the customer in the best way. And we look at the customer service scores and help those to be good. But also typically, in a lot of cases, oversee the accounting and the taxes and oversee the financial accounting staff. Now, a certified public accountant, which is the other thing we were talking about, a CPA, is different. It's a designation that people have to go and pass a very rigorous test to be a certified public accountant. A CFO, a chief financial officer, might be a certified public accountant if they've gone out and passed that rigorous exam that the CPAs have passed. So it's a certification, it's a quality level that helps you get assurance that this person has been through that rigorous accounting testing and knows a lot about accounting, enough that they could pass a very rigorous test. Now, another thing that's a little bit different is in a lot of cases, a CPA or a certified public accountant, in a lot of cases, they're not working for a private company. Like, they wouldn't work for your company. They would have their own public accounting company that would specifically get paid to do taxes and to do audits. And a lot of times that's what a CPA will do. So they may have their own CPA firm, and they would come and do your taxes, or they would come and do your income taxes, that kind of thing. So the chief financial officer is responsible for the overall financial health within a company. And then the CPA, in a lot of cases, is an external person that's going to do audits and taxes, and in some cases, accounting or bookkeeping work for the company, but doesn't usually work for the company. They're usually not a direct employee of the company. The reason that this is so confusing is because the CPA is not only somebody that has a certified public accountant firm or a CPA firm, but it's also a designation that somebody can have. So in that aspect, you could have a person that's passed the CPA exam that is your chief financial officer or your internal head accounting person for your company.
Okay, excellent. The next question is, does my bookkeeper have to be a CPA?
That's a great question. And the answer is no. Your bookkeeper doesn't have to be a CPA. Now, it's great if they are, because again, a CPA has passed a very rigorous test. So you can have more assurance that they know, a pretty good amount of different aspects of accounting and bookkeeping. And so they're very experienced in, for instance, knowing how to classify things and knowing how to properly present things on your financial statements. And we'll talk more, financial statements, that's your your different statements that are produced that show your financial condition. So the bookkeeper does not have to have passed that test, and a lot of people haven't. A lot of people that are bookkeepers haven't. It doesn't mean they're bad. There's some very good bookkeepers out there that haven't passed the CPA exam, so it's not required. But it usually, if they've passed the CPA exam, you typically will feel a little bit better and typically feel a little bit more confident that they do know their stuff because they passed that certification. In some cases, they might be more expensive. In some cases, they're not. Yeah.
Okay. Now, when banks and lenders request the business financials from a company, what are they typically referring to?
Yeah, that's a great question. And these financial statements, these are written documents that tell the financial health of your company. So like if I go see the doctor, then the doctor is going to ask me a bunch of questions and whack me with this thing and look in my ear and look in my eyes and all this to determine my health. And he's going to look at all the different aspects for the most part of my body, or kind of the important things. And so then he's going to write up a report, and he's going to, he may put it in his computer, or me actually write it out. And you probably even can request, his doctor's notes from your exam. So what he's done is he's documented the financial health. Not the financial health. He's documented your physical health of your body. The financial statements are a way, and they're a standard way that we document the financial health of your company. Now, there's different types of financial statements, and we'll run through what the basic ones are. But this is a standard way to have a standard set of reports that you can look at that tell the financial health. Now, the thing is, one of the big things on financial statements is you want to always ask the question, what does this tell me? And why are the numbers that are on the financial statement, why are they that way? So like your doctor, he's going to, maybe do some blood work, and he'll figure out, okay, here's the score for your cholesterol. Your cholesterol is at 199 or whatever. And then there's going to be a range that's kind of acceptable that shows that's good or bad. Okay. So financial statements are the same way. They'll give you all the numbers for it, but you want to understand and learn to figure out, is this good or is this bad? Okay. And then you also, the big thing you want to do is you want to ask some questions and find out more so that you can figure out why the financial statements are the way they are. Why are the numbers what they are? Because these numbers tell a story. For instance, if the sales number, the amount of sales that you made for the month, if it went up versus last month, well, that's good. That's great. But you want to know why. You want to understand, did we do something different that made the sales go up? If that's the case, we want to write that down, and, maybe we keep doing that, or maybe we do more of that. Did the sales go down? Did the financial statement show that the sales went down? Oh, well, that's usually bad. And so we want to figure out, did we do something different, that made it bad, or what can we do to make it better? So they're a tool that can be used to make, assessments of how to make your business better or how to make it worse. So they take the temperature of your business and show, where it is, and this is what the numbers are. And then you can analyze based on that. And you as the business owner want to do that. Now, when the banks do it, they are wanting to have this be an objective way that they can determine the financial health of your business. Because banks, like if you're applying for a loan, they are giving you their money to use. Now, they're going to charge you what's called interest for it. So you have to pay them some extra, and you have to pay them back for the loan. But they're giving you their money, and they're risking that they're going to give you their money and that you're not going to be able to pay it back. So they want to make sure that they're being very prudent before they give you that money. One of the main reasons that they do this is they're going to ask for the financial statements so that they can do their evaluation and figure out, are you profitable? How much money are you making? Do your numbers look good? Do your numbers look bad? Are they getting better? Are they getting worse? That kind of thing. So your financial statements, they tell a story of the finances of your company, and that's what the bank is using them for. So the big thing is you want to have financial statements. So you're probably not going to get anywhere with a bank if you don't have financial statements, because that shows the business, the bank, that, well, you don't even, you haven't even taken enough financial diligence in order to create your financials. Now, if you're a new business, you may not have an established track record. But if you're a business that's been in business already, you definitely want to have some financial statements. And that helps the bank to evaluate your financial condition and figure out how confident they are that they can make you a loan and give you a good interest rate. And the more confident they are, the more likely that you are to get the loan, and the more likely that they're going to feel confident enough that they can give you, maybe a little bit better rate. Let me just run through the basic kinds of financial statements, because you really want to pay attention to especially the first couple of these. And the 4 different financial reports give you a different snapshot. It's kind of like we have, we wanted to see what this mountain looked like. We were on vacation and we wanted to see what it looked like. Well, we took a picture from here, but we didn't think that picture was quite as good. So we went over and we took one over here. So we take these different snapshots so we can really get a more full picture. So there's 4 different types of financial statements. And the first 2 get a lot of looking. And the first one is what's called an income statement, or it's also called a profit and loss statement, or you may even hear it called as a P&L, which stands for profit and loss. And basically, the profit and loss shows how much money you made or lost for a certain time period. So it might be like for a month, or it might be for a year. But we're looking at some certain time period, and it's going to show how much revenue you had, how much sales you had for that time period. It's also going to show what your expenses were for that period. And then it's going to show the profit or the loss. So if your revenues were more than your expenses, then you wound up with a profit, which is good. That's a happy face. And if your revenues were less than your expenses, if your expenses were greater, well, then you had a loss. And, in most cases, that's not as good. So you've got that. And so that's for a certain period of time, and it's called an income statement or a profit and loss statement. The next one is what's called a balance sheet, or it's also called an asset and liability report. And what it does is it shows what you own and what you owe. Okay, so this is another different snapshot to look at your financial condition. You want to have what's called a lot of assets, like a lot of assets are things you own. That's like, maybe cash or receivables from your customers. They're getting ready to pay you. You've done services for them, and they owe you money. Okay, so you want to have a lot of assets or things you own, and you want to have the other thing is liabilities. Okay, so that's the amount you owe. So you want to owe as little as possible. Okay, so you want to own a lot, but not owe very much. It's just like in your personal finances. You want to have a lot of money in the bank, but you don't want to owe very much on your credit cards. So it's kind of similar with a balance sheet in that, general rule, the more assets you have, the better, and the fewer liabilities you have, the better. And so that's kind of the big portion of the what you own and the what you owe report, which is the balance sheet. You've also got what's called the third report out of the 4 is a statement of cash flows. And it really just shows where your money came from and where your money went as far as the source of it. And there's 3 different sources. Either you got your money from your operations, which means you went out and you sold your products and you paid your expenses. And then, here's the amount of money that you generated from your operations. There's also money from financing. So, maybe if you're, from investments. So if you're a company that has a lot of investments that you invested in, maybe a bunch of stocks and bonds, you would have some earnings from that. So that would be from investments. You could have paid some investment expenses related to those. And then the third category is from financing. And so that's money that you got from the bank or that you paid back to the bank. So what we would love to see is that you have a lot of cash flow that came from your operations. So, you went out and you sold stuff and you kept your expenses to a minimum and you sold a lot of stuff. So you made a lot of money or a lot of cash flow from your operations. Now, we can get some money from the bank and put that down in the financing section. But, hopefully we're making it from our operations and not from having to get it from the bank. Although at the beginning, in some cases, you may get it from the bank. But that's kind of some of those. The final one is a statement of retained earnings. It's kind of a history of the earnings of the company and the stock that you've, if you have a stockholder, you know how much they've put into it, how much you've paid in dividends out to your stockholders, you know, what the lifetime earnings of the company was. So it's kind of a historical report. Not doesn't get quite as much scrutiny. The big ones are the income statement, which is also called the profit and loss, and then the balance sheet. The income statement is what you have earned, and the balance sheet is what you own and what you owe.
Okay. What is a break-even statement?
Yeah, exactly. So the break-even point is it's a calculation that you do, and if you think of your personal finances, um, if you feel like every month you're getting behind and you're having to put more and more on your credit card, then it may be because you're not breaking even every month. And so you got to think about, you know, you want the money that you've got coming in every month to be at least as great as the money that you've got going out. And if the money that you've got coming in is at least as great as the money that you've got going out, then you broke even for the month. Okay. Now, granted, it's preferable if you had some extra money left over. You want your money that you've got coming in to be more than the money you've got going out, because if it is, then you know, you made a little extra money. You've got some money you can put in savings, you know, or maybe you can go, you know, save up for something special for yourself. But your break-even point is similar, except it is for your business. And it's the point at which your revenues that you had coming in, or the sales that you had coming in, were enough to cover all of the expenses for the, let's say, the month or the year. Example, let's say we own a grocery store. You know, you got to go out and you got to pay expenses for the grocery store. You got to pay your employees. You got to pay the rent. You got to pay the electricity. And then you also have to go buy the food that you're going to sell to the customers. Okay. So you go buy it at a lower price, and then you're going to sell it to the customers at a higher amount. And if you sell enough groceries and you sell them at a high enough price, then the amount that you've got coming in for that is going to cover the cost of the rent and the employees and the electricity and the food that you had to buy. And if that's the case, then you broke even. So if you know your expenses are going to be, you know, let's say $5,000 for the month, that means you need to make sales of at least $5,000 to break even. Now, it doesn't mean you made profit, doesn't mean you made extra money, but it is a very important threshold, because getting to that point where you're at least breaking even means that you're not going backwards. You know, you're at least maintaining. Now, your next goal is going to be to move forward and to be making a profit, to beat the break even point. But break even is still a very significant measurement point.
Excellent. How would you recommend a new startup budget for a bookkeeper?
Great question. You know, it's kind of all over the board as far as how much a startup needs for like the bookkeeping services. I've seen it be anywhere from like, you know, $250 all the way up to $20,000. And it varies a lot based on the complexity of the company and the extent of the operations. Are there a lot of transactions, or there are not very many transactions? How complicated is the bookkeeping? And so there's a lot of different things that go into it. There's other things that are accounting costs. You know, the bookkeeping is keeping the books to kind of know, you know, did you make money? Did you lose money? You've also got stuff like your tax preparation. You can, you also, you know, you may have to have somebody pay your bills for you, or you may do that yourself. The bookkeeping is kind of the financial statements, and, you know, maybe you pay the bills, but you may or may not have somebody to process the payroll for you. It can run anywhere from, you know, that big range. I would say, you know, probably you should budget at least $400. It's nice if you can budget, you know, maybe a couple of $1,000 at least. And again, these are very, very rough numbers, because it does depend on a lot of different factors. But another thing that is helpful in a lot of cases is if you can get some, not only your financial statements done or your bookkeeping done, and your taxes. But if you can get some expertise of some interpretation of your financial statements and get people to help you understand and someone to help you, to grow your business and to help you figure out, how you can make the financial statements, I like to say, happier, how you can increase the revenues and how you can make more money. Sometimes you can also get, like a monthly meeting with your financial expert, or sometimes more than one meeting. I do business coaching with people, and a lot of times some of the stuff we talk about is financial, or sometimes it's operational on how to make the financial statements better. If you can afford to get something where somebody can help you and kind of be a coach to you, or give you some limited CFO time, that's something that can be helpful to you. A big business, finance doesn't get less important over time. A big business is going to spend, hundreds of thousands of dollars per month on accounting and finance, because the business grows and it gets more complex. And we have to have the numbers right, and we have to have them correct. We have to know where we stand from a financial standpoint. And we also have to use those numbers to help us figure out where we're going and predict the future based on what the past is, and then other things that we see going on. So we want to understand if we've been profitable, and if we haven't been profitable, we want to figure out how we fix that. So we have to have good numbers. So just the bookkeeping is one price. If you can get someone to help you and help you interpret the numbers, and then figure out, kind of how to help your business grow and help you understand what the numbers mean, that's even better and can be a good investment for you. So if you can include some coaching with it, that's great. But you do need the bookkeeping no matter what. There's also the business setup from when you set your company up at the beginning. You'll want to figure out what type of business you want to have, and register it with the state and register it with the IRS. And that can run, $1,000 or $2,000 in a lot of cases. And that's usually a good thing to help you get set up properly.
Okay. What are 5-year financial projections?
Exactly. Yeah. So a financial projection is an estimate of the future. It's kind of like a budget. If you do your personal budget, you may look out and you may say, well, I'm going to be making this amount of money this month, and then I'm going to go have all of these particular expenses, and my rent is going to be this much, and my food is going to be this much, and then my income was this much, and you make what's called a projection out. A budget is a financial plan. It's a projection. So you want to project out what your finances are going to be. So you're going to have your revenues coming in, you're going to have your expenses going out. A 5-year financial projection is taking a multi-year view of your financial projection. So you're going to plan it out. And a lot of times, like maybe a bank will ask for a 5-year projection. So this is something where you're taking your numbers, you're estimating them, you're putting them on there, and you're going to put them on either paper or on a spreadsheet, and you're going to look at 5 years out and make what your estimates are. So you're projecting it out, how much revenue, how much revenue each year. You might even do it how much each month, where it's going to come from, what types of revenue, how much your expenses are, and then how much your profit is. When I was in college, I had a professor, and I went and saw him, and he was kind of a mentor, and he said, well, what do you want to do with your future? And I'm like, well, I want to, I'm in college and I want to finish college. And so, he said, okay, well, after that, what do you want to do? Do you want to have a house someday? And I thought, well, yeah, I'd like to have a house someday. And he got his little message board up there, and he said, okay, well, that's going to be about this much. And I'm like, oh, and, then he said, do you want to have a new car someday, replace the car that you have? And I'm like, well, yeah, I don't want to drive this car forever. And so he says, well, let's say that's going to be about this much. And I'm like, wow, and so that was kind of a plan that he helped me to develop. Now, it was a long time before I got the house. I think it was probably about 15 years before I actually got the money and did the down payment and everything, and actually, got the house. So it was a long-term thing. But once I know where I want to go like that, like in this case, it was what items do I want to have in the future, then I can go start making my plan or my projection for, okay, I need to really be setting some money back every year so that I can save up and eventually be able to do this. And so that would be an example of a projection. But for your business, the 5-year projection is taking all of the income and all of the expenses, your best guess, and putting those down on a projection.
Okay. How does a new startup determine their estimated growth when doing a 5-year projection?
Yeah, this is a very important thing to do, because there's different types of estimates that you can make. You've got to make your best guess for what your growth is going to be. And it is an educated guess. There's no perfect magic ball or perfect answer. So you sometimes even want to do one that's like, if things go really well, this is the growth rate I'm going to use. And if things go really poorly, this is the growth rate I'm going to use. Maybe it's zero growth, or maybe it's negative even. You hopefully not. You need to figure out how to fix that problem if that's the case. But then you typically will do kind of a middle of the road. This is my most realistic guess. And so there's a lot of different things that can determine it. And what I like to do is just go, not worry so much with, is it going to be 10% growth? Is it going to be 50% growth? But go put down the numbers as best as you know it in like that financial projection that we talked about in the last question. Go put down what you think is going to happen. So I'm going to start my business this year. I'm going to guess that I'm going to open in June, and I think I'll probably have, that first month I'll have, $1,000 a sale. And then I'm gonna do some marketing. The next month it's going to be $2,000 a sale, and then, I think for those first 6 months, it's going to ramp up like $1,000 every month. And so, after the 6-month point, my sales are going to be up to $6,000 for that month. And then you estimate what your expenses are going to be for that. And then you're going to want to do that same type of exercise, taking your educated guess as far as, if I grow at the speed that I think I can grow, and the assumptions are kind of what I think they're going to be, this is what it would be. And you just write down what it is, like month by month or year by year, based on the path of growth that you think is going to be realistic for what you're doing. And it's like, when I one time ran a marathon, and I had to work up to it. There was like this list that they gave me that said, okay, here's how you work up to it. 3 months out, you're going to be running this much every day. And then 1 month out before the marathon, you're going to be all the way up to running this much every day, maybe 5 miles a day or something, or 10 miles. And then the 2 weeks before the marathon, you're going to go and you're going to run 18 miles that weekend, because you got to get all the way up to where you're ready for the day of the marathon. And it's like 26.2 miles, so you've got to work up to it. Well, your business is the same way. The first time, just like the first time I went out and ran, maybe that's 5 months before the marathon. Well, I didn't run 26 miles. I couldn't have run 26 miles. Okay. Because I was just starting out. And so your business is like that. You want to put, here's the numbers that I think I can do when I first start. And then you build the schedule of, here's what we're going to work up to. Here's how much I can do each year. Let's say I'm going to do home remodeling. So, the first year I'm going to buy, an old dilapidated house. I'm going to spend, I think, about this much. I'm going to spend $50,000 to fix it up. And then, it's going to take me the whole first year in order to do all this and get this first house done. And then at the end of the year, I'm going to sell it for this much. Okay, so that means I'm going to make, let's say, $20,000 of profit the first year. Okay, well then the second year, I'm getting better. Maybe I'm going to hire a little more staff, and I know more what I'm doing, so I'm going to be able to do more. And plus, I made that profit last year, so now I've got a little bit of extra money that I can put into buying it. I'm going to buy 2 houses this year. So I'm going to buy 2 dilapidated houses. And, I'm going to get 2 of them done this year, and I'm going to sell them both. Okay. So in year 2, I'm going to sell 2 houses rather than 1 house. So I've got more revenues now, I've got more expenses, and I've got more profit because I sold twice as many as I did last year. So you kind of think through, what is the pace that I can do this at, and how much growth do I think I can have in order to get the 5-year growth. So when you do that, you've kind of mapped out your 5-year projection, and then you go back and you look at, okay, well, in the first year, I had 50% growth. In the second year, I had 40% growth. In the third year, I had 25% growth. Now it sounds like, well, wait a minute, my growth is going down every year. That could be the case, but the thing is, you're getting bigger every year. So that's not necessarily bad. There's some companies, they could have 100% growth, double their sales for 3 or 4 different years. And it doesn't matter. You don't even have to double. There's no rule exactly on that. But you'll figure out the growth rate after you've done the detail of looking at what you think is realistic for how much you can grow. And sometimes you'll do that and you'll be like, you know what, this is just not good enough. Well, it could be that you were too easy on yourself. You said, well, I'm going to grow just this much, and then just this much, and then the next year just this much. But you look at it again and you think, well, wow, that didn't get me very far, did it? Well, then you want to go back and say, well, you know what, could I do this faster? Could I grow faster? Am I being too easy? Can I do more realistically? And anyway, if you look at it like that, then you can it's kind of a reverse way to figure the growth rate, but it may be a very realistic way. And you could guess from the beginning and say, I think I'm going to grow 10% every year. But I would go back and I would do the homework then of your 5-year financial projection and see, based on when you mapped it all out like that and wrote it all out like that, then what growth rate did you really wind up using when you thought through the operations?
How does a new startup determine the estimated, how would you determine the financial value of your company?
That's a great question. And the reason that it matters is your business is what makes you money. And your business, if you're a business owner, is an asset. It's something you own. So you want the value of your asset, or this thing that you own, this baby that you've got that you're raising, you want it to have the biggest value that you can. And the more financial value it has, the more you may be able to sell it for in the future, or the more valuable it is, the more it's going to be able to generate for you in the future. And what is the financial value of the company? What does that mean? What it is it's a reflection of the future earnings potential of the company. So in other words, the value of your company is based on what it is going to be able to generate in the future. If I buy your business, I'm buying it because I think that it's going to be able to generate me money in the future. And so that's one of the things that you're paying a lot of attention to, and what it is, what this financial value of your company is we have to figure out a way to determine the future earnings potential of the company. Now, there's a couple of different things that make up the value of the company. One of them is the amount of assets that the company has. So for instance, if you have a lot of equipment, well, that's part of the value of the company. If you have a lot of inventory, or things on the shelf, say you're selling toys, if you've got a lot of toys on the shelf, or say you're an eye doctor and you've got a lot of glasses there for your customers to buy. Those are inventory. So those are assets. So that's part of what determines the value of your company. But the bigger portion of your company in a lot of cases is what you've been able to do to generate earnings. You've got a lot of customers. Your customers are going to come back. Your customers are willing to pay a high price because it's good stuff and it's a good company and they know you're going to do a good job for it. A lot of times the financial value of your company kind of equates to what somebody would pay you for it. So if someone was to buy your company, how much would it be worth? Now, it's often expressed in what's called times earnings. Okay. So let's say you've got a business and that business this year is going to make $100,000. Okay. Well, let's say somebody wants to buy your business and they come look at you and they've got to figure out what the value is. Well, they're going to consider a lot of different things, but one of the things is going to be the earnings. And if they look at it and they say, wow, okay, this company makes $100,000. Well, they might come and they might say, it seems to me the financial value of your company is about $100,000. So do you want to sell it to me for $100,000? And I would, that might sound good to me, or that might not sound good to me. And to the extent that I think that the future earnings of the company is very high, then I'm going to want a higher value, or I'm going to place a higher value on my company. So if I'm pretty sure that my company is going to make me $100,000 every year for the next 10 years, and you offer me $100,000 for it, I may say no, because I'm like, wow, I'm in an industry where people are dying to buy from me, and this product is always going to be needed by people. There's not a lot of competition in my area, and there's not likely to be much more competition in the area. And so I'm thinking I'm pretty set on that. I'm going to get this $100,000 just by keeping my company. So I'm not going to give it away to you for $100,000. So, you might say, well, you know what? Okay. Maybe that company is worth more value than that. So rather than it be worth 1 year of earnings or $100,000, somebody might offer me 3 times the earnings. So if it's generating $100,000 every year, and both parties are pretty sure that it's going to keep doing that, they might offer me 3 times the earnings. In other words, $300,000. So there's these different things that help us know the value, and there's no perfect number, because it's always an estimate. So even if somebody pays you $300,000 for it, they're still having to take an educated guess as to what the value of the company is. But we can look at these numbers and we can kind of tell. For instance, if you had a company that wasn't making any money, well, if somebody comes and offers you $100,000 for it, that might be a great deal, and you may want to sell it. There's different qualitative factors, but it's things like, how much equipment do you have? How much assets do you have? Here's some things. I'm going to get a higher value for my company if it's growing, if it's profitable, it's making a profit, if it has good prospects for the future, the customers are happy, and there's every reason to think they're going to keep coming back, and they're going to keep being happy. And the business is going to continue. Then it's worth more. If the company sales are declining and they're getting to be less and less, the company's not making any profits, the prospects for the future don't look very good. And in all those cases, that makes the value go down. And, you can think, well, my financial value of my company is less. So do I have the confidence that people are going to keep buying from me? That's another thing that has to be considered. Do I have people who work for me in my company that have good knowledge and that I'm pretty sure are going to stay in the future? If your people that work for you are happy and they want to stay with your company, then that makes your company worth more. If it's like all your people are leaving and you constantly have trouble with turnover, well, that may make your company worth less. Another thing, if it's in an industry that's growing and that's healthy, that's a good thing for the value of your company. If your products are something that's going to become obsolete, if cell phones are getting to be more and more popular, and you're a company that invests in phone booths, some of you may not even know what a phone booth was, but before cell phones, you'd have to go pay a quarter and put it in there in the telephone booth, and you could make a phone call from there. You almost don't see those anymore except in museums. And so if you were a company that was investing in those payphones, that's not a good thing for the future. So those are different ways that you can value your company. It's an art, and you want to do the qualitative things to make your company be a quality company that's going to have good customers and good customers in the future, providing good services, and you're going to be able to be competitive and make the changes that need to be made in order to stay competitive and to stay on top. Those are good things that increase the value of your company, as opposed to the opposite of that, which decreases the value of your company. So you can look at the times earnings thing, what the earnings are, and figure out how much somebody may be willing to pay you. If you've got people that are actually making you offers, you can see, well, here's what my business is, how much do you want to pay me for it? That's an indication of the value of your company. So there's different things that go into the valuation of your company.
Is there a formula or a rule of thumb for a new startup to use to determine how many shares to create?
It depends on the type of company that you're making. So there's some companies that are formed in order to get a whole lot of people to invest in it, which would be a whole lot of what's called shareholders. So these are people that give the company money so that the company can operate. And in exchange for that, they get shares of the company, which represent an ownership interest in the company. So like, if you're going to be a public company, which is going to be registered on a stock exchange, then that means you're planning on having a lot of people invest in it. If that's the case, you may need to set up your business where it has like 10 million shares. That's not an uncommon number for a company that's going to be, a public company that's going to be issuing a lot of shares and have a lot of different shareholders. Most companies are not that. Most companies are going to be small or mid-sized companies. They're not going to have near that many people investing in them. And so therefore, they can have a much lower number of shares. Technically, if you're going to be the only owner in the company, then you could just have one share and you're the shareholder. So you're the only shareholder and you're the one that has the one share. Now, even that would be okay, because if you decided later that you were going to take on some additional shareholders, you could take that one share and you could split it up into fractions of the share. And you could say, I own half the business. That means I own half of the share. And you could split the other share, the other half of the share among 5 different people or whatever. So you'd be okay no matter what. For most companies that are going to have, a small number of investors that are owning part of the company, something like 100 shares or 1,000 shares or 10,000 shares is fine. So there's no magic number on that, but the fewer number of shareholders, the less shares that you need. It's not a big worry, because you can always change it later. You can have a stockholders meeting and increase the number of shares, vote to increase the number of shares. The board of directors can do that. So it's okay either way. But if you're going to have multiple shareholders, you probably want to have more than one. And it sometimes looks kind of flashy, the more shares that you have, because then you can say, well, I hold 5,000 shares in that company. That sounds like a lot, but maybe there's only 2 shareholders and there's only 10,000 shares. But, another thing to think about on that is the number of shares that you, not that are authorized, but that are issued, is what determines your percentage ownership of the company. So if you're the owner of the company, you typically want to try to maintain the primary ownership or be the majority stockholder of the company. So you're going to want to have at least 50% of the shares, so that you're the primary stockholder of the company. And so that's just kind of a general rule. There's different aspects of that, but that's kind of something to think about also.
What is the typical return on investment, or ROI, that new startup should offer to investors when raising capital?
Yeah, this is a great question, and it's difficult to answer, because there's all kinds of different scenarios. And what we're talking about here when we say investor is, when we start a company, there are we may not have all the money that we need to start the company. So we go look for somebody to give us some more money. And there's a couple of different ways to do that. One is you go get a loan, and like you go to the bank and the bank loans you the money, and they're making an investment in you. But the way that works is you're going to pay the bank interest. So they're going to give you a standard interest rate. So for instance, maybe they'll give you some money and you're going to have to pay them a 6% rate or something like that. It's calculated based on the amount of the loan that you take out. There's another way to do it, and that is to get stockholders or shareholders. And for that, you issue some shares to them, or you issue a percentage ownership in the company, and they get a certain number of shares, and their shares are some percentage of the total shares. So they own a percentage of your company. So like if you issue, if you've got, 1,000 shares and you give them 100 of them, well, they have a 10% 10% ownership in your company. And for that, you would give them some money. Now, what is the rule for how much to give them? It's subjective, but there's some rules that you need to pay attention to. And the biggest one is you're not going to give them more than you can afford to give them, or more than the company can generate. So you want to give them basically as little as you can for their ownership in the company. So you need to get the cash that you need to get, but you want to be aware that when you're giving them money, when you're giving them shares of your company, you're giving them a percentage ownership in your company. So the amount that you can give them is you can't give them more than the company can afford. So for instance, I'm not going to just turn right around and give somebody a 60% ownership in my company if they're just giving me some very low amount of money compared to what I need. Okay, so we can't let the investors or paying the investors break the company. So we can't afford to give them more than the company can afford to give. And how do we know how much the company can afford to give? Well, we've got to have the money to operate the company. And then also, what do we think the company is going to generate in the future? Well, we can't be giving them proportionately high numbers compared to what we think it's going to generate. So you kind of have to ask, what am I giving away, which is like a percentage ownership in the company, and what am I getting for it? So I want to get a lot for it, and I want to be careful and try to minimize the percentage of my business that I'm getting away. So you want to give away as little as possible in order to get the money that you need to run the business. And we want to do it in a way that works for the company. So for instance, let's say we have an investor and we think that we're going to be able to give them some type of payback or a dividend, as it's called, in the future. We're probably not going to give it to them until after we've started earning some money, and then they may be able to get some kind of payback. Or if it's a loan, I don't want to, if I need money for the next 6 months to operate, I don't really want to go get a loan with the bank and then have to make a payment on it next month. Maybe the bank will require that, but it'd be great if they could wait 3 months before they start making me pay back the loan, or when maybe they could wait 6 months. And then I could start making the payments on the loan. So you want to take out the money in a way that's prudent for the business. Now, it varies greatly based on the type of investor and the risk of the business and the certainty that the investors are going to get paid back. All those things count as far as how much you may need to offer them as an investor. Now, the other thing is that there's different types of investors. And I like to use the example of, let's say, there's a lot of times simple investors. Maybe your grandma's going to help you out. Maybe she's going to invest in your company. She already knows you. She knows what she feels comfortable with. And, maybe she's got her money in the bank and she can only get 2% for it there. Well, she might, because you're her grandkid, she might give you a 0 interest loan. So she may not charge you any interest at all. Or, maybe she might be happy with 6%. She can leave it in the bank for 2%, or she can give it to you and you'll pay her back in a year and you'll give her 6%. So maybe that would be good for her. And so that there's people that have a personal relationship with you, which could be family or friends. That's one common way that people get money to invest in their business if they don't have their own money that they can invest in it. On the other end of the spectrum, there's the sophisticated investor. Now, this is probably not somebody that knows you, but it may be somebody that you have to seek out, somebody that's an investor. And that could be somebody who knows exactly what they want out of an investment. And if you fit that profile, or if you're that type of person, then they may be willing to loan you the money. Now, they can be very specific and they can know exactly what they do. For instance, where I am, in the city where I am, there's a venture capital firm, which is an investment company, and they will only invest in something that they feel like they're going to get back a return of 15 times what they put into it. Okay. So they're going to look at your numbers and your financial statements and your business plan, and they're going to see what you're doing. They're going to ask you some questions about it. And if they feel really good about it and they think, you know what, this could really make a lot of money. So, if they think that, yeah, they can probably, if I give them $1,000, I'm probably going to get back at least 15,000. So that would be 15 times what they put into it. That's kind of what their minimum requirement is in order to do business with you. And so there's that. And they're also specific in that they're only going to invest in software companies. Okay. So, if you're a grocery store, they're not going to invest in you because they don't invest in grocery stores. Okay. They're a sophisticated investor and they're looking for a certain thing. So here's a good thing to do when you're talking to potential investors. You can kind of tell them what you do. And, then you can ask them, what kind of return do you generally look for the things that you like to invest in? And if they're a sophisticated investor, they probably know. Now, if it's your grandma, she's not going to know how to answer that question. Okay. So it's a whole different thing. So sometimes you're going to know enough that you can think of, here's what my company is, here's how much money I need, here's how much I can afford to pay. And then, you can have that conversation with your family member, your friend, or, somebody that you know. That's one way. The other thing is if it's somebody that you think is more sophisticated and you have no idea what you would need to offer them, you can ask them what do they invest in and what type of return are they looking for. And if it sounds like something that's way out of your league, you may that may not be a good fit. But if it's a reasonable number, then you can ask more questions and you guys can see if you feel like you'd be good for each other. But the thing is, when you don't have to promise them a type of return. Like if they're a stockholder, if you're going to issue some stock to them and give them a percentage ownership in your company in exchange for them giving you some money, that type of relationship is not that you're promising them a certain return. What you do is you give them the facts of what you think this thing is going to do and what kind of profitability you're going to have, you think, what your business plan looks like, what your projections look like, and then you're going to answer questions. They're going to see if they're comfortable with your answers and if they feel like you can achieve what you've put on that piece of paper, or if they don't, they're going to be requiring more if they feel like it's not achievable and it's more risk. The more comfortable they feel with it, the less they may ask for as far as a return from you. But they're banking on that you're going to be able to achieve a certain amount of return or a certain amount of profitability. And because you do achieve that, their investment or their percentage ownership in your company is more. And so they're going to kind of be making their decision based on what return they think they're going to get, say, from dividends once your company gets to be profitable, or from once, let's say they think you're going to be able to sell the company to somebody else. And they think, I think if he gets $100,000 to start up this business, I think in 5 years, he's going to be able to sell this thing for $5 million. And so then they'll calculate what their return would be based on that. And if they're comfortable with it, then maybe they'll take, a 10% ownership in your company, knowing that they're taking the assumption that, if the thing goes belly up, you don't make any money, they could completely lose their investment. But if things go well and they feel like you've got a really good shot of them going well, then maybe they think, well, your $100,000 that they gave you, once the business gets sold in say 5 years, they think they're going to be able to make $1 million off of their percentage portion of the company. So that's kind of some things about how it works and how you can use that information to kind of figure out what you might be willing to offer. You can't offer so much that it stresses the company too much and that the company can't afford to pay it. And then if it's a sophisticated investor, then a lot of times you may want to ask, what are they looking for on their return? And you've always got the option of saying, well, I don't think we can do that. I don't think I can meet those requirements. So it's not like you can't negotiate, but let them tell you kind of what their expectation is. And then, if you need to negotiate it down, well, if they don't like it, they can walk away. They don't have to invest, and you don't have to overcommit yourself to giving away more of the company than you think you should.
Okay. What are some of the KPIs that a small micro business seeking to raise capital should be focused on?
Yeah, this is a great question and such an important thing. And first, let's talk about a KPI is a key performance indicator. And so that's something that we think is important as far as something about our business. And it's so important that it's a key or an important performance indicator and one that we want to keep an eye on. And so it's kind of like the dashboard on your car. You may have a gasoline gauge on there because that's a key performance indicator. If your gas is about to run out, that means you're in big trouble and you want your dashboard to be screaming, and to be flashing the red light and everything. Hey, we're about out of gas. You better do something about it. Okay. And you can always look at your dashboard, at your gas gauge, and see that it's in a comfortable position. Okay. So that's the thing we want to do with our key performance indicators is we want to, there's a million different numbers that we could look at and a million different statistics and everything. So we want to choose some and say, these are our key ones. These are things that we want to make sure are good. And I like to think of it in terms of, we want to keep our customers happy. You want to keep your employees happy, and you want to keep your finances happy. Okay. So those are kind of some things that you want to have key performance indicators on. Now, as far as the financial, one of the biggest things is your cash flow. Okay. So you want to make sure that your amount that you've got coming in, or the cash that you've got coming in, is greater than or exceeds the amount of cash that you've got going out. Okay. So there's an old saying that your inflows must exceed your outflows. Otherwise, your upkeep will become your downfall. Okay, so your inflows must exceed your outflows. Otherwise, your upkeep becomes your downfall. Okay, so what that means is that the money you've got coming in has got to be greater than the money you've got going out. Okay, otherwise you're in a cash flow negative standpoint, and you got more money going out than is coming in. Okay, and that's not going to cut it. So your cash flow is your biggest thing. That you want to see that you've got enough cash going in that it's going to allow you to pay all your bills and hopefully have some left over. Okay, so that's a key performance indicator, is that your cash flow positive. And you want to remember, as you do your evaluations, things like taxes. Those you don't have to pay taxes on, like your income tax every month, but you do want to be setting aside some for that. So don't forget that some expenses aren't every week, or some expenses aren't every month, but you still have to save up for them, and consider that in your cash flow and your upcoming projections. Okay, so part of cash flow is a different element to it, which is your forecast. What you're forecasting, or you're planning on, or you think you're going to have coming in as cash, and what you've got going out as cash. Okay, so that's your cash flow. You want to be cash flow positive, and you want to keep profitable, because otherwise you'll go broke. You'll run out of money. You have to have enough money to exceed paying your bills and paying the taxes and all that kind of stuff. So you want to build up your cash reserves. Okay, so you want to set some money aside. So that's another key indicator, is how much emergency cash do I have, or how much extra cash do I have that is more than my cash flow. Okay, so you may have heard of the financial coach guru for individual finances, Dave Ramsey. And, he says, okay, here's the basic rules of finance. The first thing you want to do is get $1,000 in the bank. So if you have an emergency, if the car has a flat tire, if the air conditioner goes out or whatever, if it's something that's an emergency, you have some money in the bank that you can use in an emergency to have some kind of cash flow, so that if you have a month where maybe cash flow is bad, you've got a little money in the bank to cover for it. Okay. Now, the second step, though, that he says from a personal finance standpoint, is you want to generate savings or an emergency fund that's for like 3 months. So let's say you lose your job, and for 3 months you don't have money coming in. Well, I'm okay, because I had that emergency fund. I had my money set aside in the bank so that I had 3 months of emergency reserves. Okay, so part of your cash flow key performance indicator is you also want to have a separate thing of how much emergency fund do I have, so that, if I had a month where we lost money, or 2 months or 3 months, what if COVID comes? Do I have some money set aside that's going to keep me cash flow positive in that? Okay. So in addition to the cash flow, and in addition to doing our forecast where we're projecting out, how much money we're going to have coming in and how much we're going to have going out, maybe for the next month, we also want to look at some basic things like, for instance, the key performance indicator of our sales amount. So how much sales did we have last month? Okay. And like when I was working for one Fortune 500 company, we would report our sales every week. Okay. So we would look at, here's our sales for the week. Okay. And then another key performance indicator that is kind of a variance of your sales is your sales growth. Did my sales go up for the week or the month? Or did my sales go down? If they went down, I want to try to find out why. And then I want to put a game plan in place to get them back up and to take corrective action on whatever the problem is. And if they went up, then that's great. I want to figure out what I did right that made them go up and keep doing more of that, figure out how to do that. So you've got your key performance indicator of what your sales are. And then separately, you've got a key performance indicator of what your sales growth is. Okay. And so the next thing, and I've got several things here, and I know this is a lot, but it's just some things to keep an eye on and to kind of keep your radar on. The next thing is gross profit. Okay. So let's go back to our grocery store example. You had your sales for the food that you sold. You had the cost of the food that you sold, what you had to pay for it in order to sell it to other people, and then you have your gross profit. Okay. So your basic thing that you sell in this case is groceries. So you have your sales of groceries, then you have your cost of sales is what it's called, or what you paid for that stuff, for your main product, which is the food. And then whatever's left on that is your gross operating profit. Okay. So that's determining how well you're doing on turning your basic item that you sell into some profit. Okay. And then the next thing after the gross profit would be the net profit. So the net profit is basically taking the gross profit and then you subtract off all your other costs. Like, I paid my employees, I paid the rent, I paid the electricity. And then did I have anything left over? That's my net profit. And how much was that? So that's a key performance indicator. The break-even point that we talked about earlier, did I break even for the month? Did I have revenues coming in that were at least as great as my expenses? That means I broke even. So that's one thing you can look at. Another thing is there's some things like customer satisfaction. Am I getting good scores, like on the internet, or if I have a customer survey where I ask the customer satisfaction, am I getting good scores on that? That's a key performance indicator of how well I'm doing. And it's an important one. Okay. And then what's called customer acquisition cost. How much am I having to pay to get a customer? If I just set my sign out on the sidewalk and people start coming in, I'm not having to pay very much to get those customers. But if I'm having to go and do advertising, on the internet or in the newspaper or on the radio, then that's increasing the cost to get a new customer. And that's my customer acquisition cost, is on average, how much do I have to pay to get a new customer to come in? So these are all things that we want to keep our customers happy. We want to keep our employees happy, and we want to keep our finances happy. So these are ones that talk about the customer satisfaction and the financial satisfaction. The employee satisfaction, there's fewer indicators on that are ones that are written key performance indicators. But there are things that you do. You want to keep a real close pulse on, learning to manage your employees, to keep them happy, and to help them to be in a state where they're happy, because happy employees will do a better job of taking good care of your customers and creating happy customers.
Okay. Excellent.